This is the accounting equation. Assets equal liabilities plus owner's equity plus revenues minus expenses minus dividends. In this video, I want to define each of these 6 categories of accounts. Then I want to list most of the accounts that we will use in first semester. And then I want to talk about the 4 financial statements. Oh, and by the way, I have listed here debits and credits with plus and minus or minus plus signs. I'm going to talk about those in the next video, but I wanted you to just start seeing them and noticing them now. Assets are what we own. That's the key word, own. Assets include such things as cash, accounts receivable, equipment, land, patents. These are things that we own that will benefit the future of the business. Liabilities are what we owe. These are our bills that we haven't paid. This is our debt. Liability accounts include accounts payable, notes payable, mortgages payable, interest payable, bonds payable. Notice that all the liability accounts have the word payable in the name, except one. There is one liability account that doesn't say payable. It's called unearned revenue. Remember that one. That's a little tricky. Equity is simply the difference between what we own and what we owe. Assets minus liabilities. It's best to define equity just with the mathematical equation, assets minus liabilities. It's just the difference. In an individual's life, a person might refer to his or her net worth. In a small business, owner's equity is called capital or owner's capital. But in a corporation, equity is called owner's equity or stockholders' equity or shareholders' equity. Revenues are what we earn. We earn something after we've finished the job, not before and not in the middle. For instance, if a dentist performs some work on a patient's mouth and the patient leaves without paying, has the dentist earned? Well, yes, the dentist has earned because I said we record revenue after we finish the job, and therefore it does not matter if we have received cash. It is possible to receive payment before we earn or as we earn or after we earn. But in accounting, we record what we earn and what we receive as 2 separate events that could happen simultaneously, but they're 2 separate ideas. Expenses are what we incur. Now there's a new word for most people. To incur something is to suddenly have an obligation. For example, if I walk into the store and touch an apple, I don't have the obligation to pay for it. But if I bite the apple, then suddenly I have incurred this obligation. Another definition for expense is a used asset. So if I buy paper, printer paper, and it's new, that's an asset. But after I use it and throw it in the trash, that asset has to be transferred over to expense. An expense is a used asset. Expenses benefited the past, whereas assets will benefit the future. Whenever a business, a corporation, pays cash to the owners, that's called a dividend. In a small business, this dividends account is called draw or drawing account. And in a small business, if an owner takes cash out of the business, that is called a draw. But in a bigger business, in a corporation, if owners receive cash from the business, that's called dividends. Next, I want to talk about all the different accounts that we're going to use in first semester. Here I'm showing you most of the accounts, but there are a few missing off this list. Notice that cash is always the first asset listed in the asset category. Cash is first. Cash is king, as they say. Cash is the lifeblood of business. Cash is the definition of liquidity. Everything else's liquidity is measured in how quickly it could be converted to cash. For example, accounts receivable might be collected in 30 days. That's 30 days until it is liquidated or become liquid. Supplies or inventory could be sold in a couple months. So that's less liquid than accounts receivable, for example. Land is less liquid because it might take 3 months to sell it. Notice we have accounts receivable and accounts payable. Receivables and payables. Beginners get these two mixed up. But account receivable is any money that we're expecting to collect. We always collect from customers. And accounts payable is money that we're going to pay, and we pay to creditors or vendors or suppliers. When doing homework, sometimes the students get the perspective wrong. So if they ever say customer, if you're receiving cash from a customer, your mind needs to go to a receivable. But if they're talking about a supplier, your mind goes to payable. Now, what's the difference between accounts payable and notes payable? Well, a note is just simply more formal. With a note payable, you have a contract that is signed and it bears interest. So in this class, notes will bear interest and accounts will not bear interest. And accounts payable will usually be for smaller amounts and notes payable for more significant amounts of money. So your monthly bills that you pay, your electricity, that's accounts payable. But if you have a loan for a piece of equipment, that would be a note payable, even though you pay it monthly also. I just want to differentiate between a supply and inventory. A supply is something that is used in-house in the business, and inventory is sold to customers. In some homework problems, there's confusion. So, for example, let's say a store has an office in the back room with paper for the printer. Also, that store happens to sell paper. Take Walmart, for example. In the store, they sell paper, but in the back room, they sometimes need to have paper also. So paper in the back room is called a supply. Paper out on the shelf for customers, that's called inventory. And in some homework problems, students can mix those two up. Just notice that there are 4 interest accounts in accounting. There's interest receivable, interest payable, interest revenue, and interest expense. Interest is part of financing. It's not part of the operations. And so financing is always held very separate from operations in accounting. Equipment, buildings, land, these are examples of long-term assets. We call an asset long-term if we intend to use that asset longer than 1 year into the future. So if you buy a new truck and you're going to be using that longer than 12 months, that would be categorized as a long-term. And all of our long-term assets are depreciated, except for land. So equipment, if we buy a big truck, we'll put it in the equipment account, or we could name it truck account, and then we will gradually move it from the asset category over to the expense category a little bit each year. And that's what depreciation is, moving from an asset to the expense category, your long-term assets. And by the way, land is not depreciated because accountants assume that long after we're dead, the land is going to exist in the same value as we found it when we were born, unless, of course, we pollute the land. You could have some kind of a gasoline station that has been leaking gas down deep into the land for 30 years. Well, that's polluting the land, and so then you could take into account that somehow. The EPA requires nowadays that people restore the land to a pristine state. So we don't depreciate land. Notice at this point that there are two depreciation accounts. We'll talk about this later in a future chapter, but what is depreciation? It's moving an asset to the expense category. Patents, copyrights, and goodwill, these are called intangible assets. Intangible means you can't touch them. Intangible assets are usually legal rights. The tangible assets are things you can touch, like a truck, equipment, buildings, land. Tangible. Liabilities are what we owe. Look at the names of these liability accounts. They all say payable. Accounts payable, notes payable. Except the last one, it says unearned revenue. And some students think, oh, that must be a revenue account. No, but it is specifically not a revenue, unearned revenue. A revenue is something we have earned, but if we have not earned it, it's not a revenue. For example, let's say I'm an NFL football team and I receive money from fans for season tickets. I received this cash, but I have not earned it. On my books, I have to show that I owe them a refund. So if we don't play the game, for example, I owe them a refund. That's a liability. But after we play the games, we can move from the liability and move some portion of the money over to revenue, because after the game is played, we have finished our job and we have earned that money. But before the game, we haven't earned it yet. Also, it says bonds payable. Let me just mention, what is a bond? A bond is a lot of things. People know that word. But in accounting, a bond is a big contract for a big loan. Well, it doesn't have to be a big contract, but it is a contract for a big loan. Whereas a note payable is a contract for a medium size or small loan. Common stock is the account we use when investors give cash to the business. So when cash comes into the business, we record that in the common stock account. And when cash goes back to the owners, we call that a dividend. So when the owners put cash into the business, that's a common stock. And when cash goes back to the owners, that's called a dividend. Now, when investors put their money in a business, the business will give them legal ownership shares or interest in the corporation's future profits and assets. If you buy stock, you become a part owner. Retained earnings. In a future slide in this video, I'm going to show you the financial statements. And in the first financial statement, we call it the income statement. We calculate net income, and that is called net income on that statement, but on this equation or this account, we don't call it retained net income, we call it retained earnings. But if the language were consistent, that's what it would be, retained net income. Now, a synonym for net income is net profit. So what I'm saying is earnings is the net income that we have retained into the business. When you make a profit or when you make a net income, there are two things you can do with the profit. You can keep it in the business or you could pay it out to the owners as dividends. Let's look at the names of some of the revenue accounts we'll use this semester. In our textbook, we're going to do simple accounting in first semester, and we're going to do the accounting for a service business like a lawyer or a counselor, a psychologist, a consultant, or a business that sells inventory. That would be a merchandising business. So these three highlighted accounts are the typical names that our textbook will call the revenue account. In second semester, we'll do the accounting for manufacturing companies, but we need more vocabulary to account for cost accounting. Cost accounting is whenever you're building the inventory, not just merely buying it, marking it up, and selling it. Okay, let's look at the expenses. All these expenses have the word expense in the title, except one, cost of goods sold. Now, I suppose they could have said cost of goods sold expense, but we don't say that, presumably because we have too many syllables in that title anyway. Some textbooks call this cost of merchandise sold, but throughout history in English, the predominant title was cost of goods sold. So goods is an Old English word for inventory. Next, I want to introduce to you the 4 financial statements. These 4 financial statements are used worldwide. The system of accounting that I'm going to teach you in this semester was developed in the Roman Empire, and it's credited to an Italian monk named Luca Pacioli. And he invented, supposedly usually one person doesn't invent these things, but he gets credited across time for having invented the system of debits and credits, journals and ledgers, and these 4 financial statements. Although statement number 4, statement of cash flows, is a recent addition to the list. Most small businesses only prepare the income statement and the balance sheet. And that's because the statement of owner's equity is usually too small and insignificant to be on a separate piece of paper for a small business. And in a small business, it might be just a footnote, or it just might not even be there at all. And the 4th statement of cash flows, well, that one takes a little more sophistication to prepare, and many small businesses don't know how to do it. And most banks don't require it when they are asking for financial statements from the people to whom they've loaned money. They don't usually require them to send statement of cash flows if they're a small business. But big businesses, anyone with a stock symbol, they have to prepare all 4 financial statements. Notice that the 2 most commonly prepared financial statements, or most important financial statements, are parts of this accounting equation. To my students that take me live in class, I drill them on these accounts, and I'll say an account, and they have to tell me what category. And I'll give them 10 in random order, and I'll say notes payable, and they'll say liability, and I'll say common stock, they'll say equity, I'll say inventory, they'll say assets, I'll say supplies, expense, and they'll say dividend. And we build up speed on this because you should know very, very quickly the income statement and the balance sheet and every kind of account that's on those statements. These are not obscure statements. They're very, very common. They're worldwide. So get familiar with them. Here are the first 3 financial statements. You might want to just pause the video and take a look at them. Let me point out a few things. How about look at the dollar signs? Some people use way too many dollar signs. The standard is that you put a dollar sign at the top of every column, and every total gets a dollar sign. Notice also that I made bold boxes around my totals. I'm not happy with that, but I'm making this slide in Keynote for iPad, and I didn't have the option of the double underline. It would be more standard for me to put double underlines under grand totals. At any rate, there are many acceptable ways of creating accounting art, but there are also many unacceptable ways. So your eyes should start noticing the common ways of producing accounting art. Two criteria I should tell you about. Less is more. So if you can make a financial statement with the least possible characters, that's better. So how could I improve my financial statements? I could go my income statement and delete all those expenses. Even though they're in the title of the name, I would leave them implied because I have expenses with a colon up top. And yes, I know I have a supplies asset account and I have a supplies expense account. But this in context is obviously expense. So what I'm saying is less is more, the fewest possible characters. And that is why, look on the income statement. See that subtotal of 10,000? I put that where I did on purpose. A lot of beginners don't like to put it there, but that's where I put it on purpose because if I had brought it down a line, I would have had to label it, which would have required more characters. Notice how these first three financial statements tie together. We have to prepare the income statement first because the net income of 90,000 is needed to calculate the statement of owner's equity. Notice how also the statement of owner's equity, that 600,000, that number may or may not be on the balance sheet. But equity, remember the two accounts I showed earlier in this video, there are two equity accounts, retained earnings and common stock. So on the balance sheet, I have those two accounts, and if you added those up, they would add up to 600. I purposely omitted the subtotal of 600 because of the criteria, less is more. I didn't want to put it there. I didn't want to label it. I didn't want to busy up my artwork with more subtotals than were needed. This is a very simple balance sheet. And in a simple balance sheet, why should I subtotal and name the obvious? These statements are so common. These statements are not written for people who don't know what a balance sheet is. These are written for people who read them regularly, and so they appreciate the simplest possible artistic formation of these statements. You want to be able to, your eyes need to be able to land where they need to land as fast as possible without a lot of busyness. This is a statement of cash flows. This is difficult for beginners and for even very intelligent people that don't produce it regularly and often. This one is difficult. So in class, we'll prepare a couple, but I'm not gonna make you search for the numbers. That's what's difficult. I'm gonna give you the numbers, and you're simply gonna have to arrange them into these three categories. The first category is the biggest category. It's operations, cash flows from operations. Most cash flows are in this category. Operations means your day-to-day, cash coming in at the cash register, and cash going out to pay all your monthly bills. Investing, that's anytime you buy or sell long-term assets. And in this class, basically the long-term assets are equipment, buildings, and land. So anytime we buy or sell those things, that's investing category. And the third category is financing. That's issuing stock or borrowing money, issuing bonds or paying off the bonds, paying a dividends. Now this one's a little controversial, but paying a dividend is in the financing category, but paying interest is in the operations category. There's disagreement among nerdy accountants that debate these things, but the ruling was that interest would be part of operations and dividends would be part of financing. Now I purposely de-emphasized the third column there, the beginning cash balance and the ending cash balance. I don't care about those things. I care about these three numbers in the middle. Let's look at it. The first number is very important. That's your money-making machine from operations. That should be a healthy positive. The next one is investing. That's a negative number. If you're not a deep thinker, you might think, oh, negative, that must not be good. But wait a minute now. Negative means you have an outflow of cash because you're investing in assets. A growing company would have a negative cash flow in investing. But let's say a shrinking company, a company that is selling their buildings off That's not necessarily a good sign. If they were selling their buildings off, they could have positive cash flow from investing. But, that's like selling your plasma. Not a good sign. And financing, in this case, well, it could be positive or negative depending. This one's negative, but what are they doing? They're paying off debt. That may be a good thing.